All right, let's get right into it. Today, we're talking about Palo Alto Networks and how this cybersecurity powerhouse pulled off an absolutely textbook pivot. I mean, they went from burning through cash like there was no tomorrow to becoming a disciplined, profit-making machine, and they did it all in just about 36 months.
The results really do speak for themselves. If you look at the wider tech market, the NASDAQ gave a pretty solid 64% return over 5 years. But Palo Alto Networks, they more than doubled that, giving shareholders a massive 130% return. So the big question is, how on earth did they pull this off? And was it always this rosy for investors? To really get what makes their success so impressive today, we actually have to go back a few years, back to a time when things looked, well, a whole lot different. We're talking about their growth at all costs era. Now, on the surface, everything looked amazing. I mean, just look at this chart. A beautiful, relentless up and to the right line. Revenue just kept climbing, nearly tripling in 6 years, going from 3.4 billion to a projected 9.2 billion. This is the kind of thing that growth investors absolutely live for. But as any smart investor knows, revenue is only part of the story, right? A car might be going super fast, but that doesn't matter if the engine is on fire. So you have to ask, what was really going on under the hood of this growth machine?
And this is where it gets really interesting. On one hand, you've got revenue soaring, but on the other hand, the bottom line was telling a completely different and, frankly, a much scarier story. From 2020 to 2022, the company was just consistently losing money. And even worse, that chart on the right, return on equity, it was in a nosedive. It hit a stomach-churning minus 90% in 2022. They weren't just unprofitable. They were literally destroying shareholder value. So how were they funding all this? Well, with a mountain of debt. This chart is just wild. You can see their debt-to-equity ratio exploding to a peak of 57 times in 2022. I mean, this was a super risky high-wire act that was putting the entire company's financial health in serious jeopardy. But then things changed. The whole era of cheap, easy money came to a screeching halt. And suddenly, investors didn't care about growth at any cost anymore. So management made a huge strategic shift. They decided it was time to flip the switch. And boom, right here on this timeline, just look at that dotted line marking the pivot. This is where the magic happens. The company goes from years of those red bars, negative net margins, to a sudden, dramatic flip into the green. Management basically steered the ship from being a cash-burning growth stock to a profitable, mature company. Honestly, seeing a company pull off a turnaround this clean, this is what gets us excited about digging into the numbers. And hey, if you're finding this breakdown valuable, do us a quick favor and hit that like button, and make sure you're subscribed for more deep dives just like this one. So how'd they pull off this incredible turnaround? Well, it wasn't some magic trick. It really came down to 3 key things they did that totally reshaped the company's finances. Okay, first, they got incredibly disciplined and turned the core business into an efficiency engine. They jacked up their EBITDA margins, which is a great way to measure core profitability, from basically zero all the way up to over 20%. This meant the business itself was now fundamentally healthy and making good money before things like interest and taxes. Second, they got way smarter with their money, especially with research and development. This chart is a perfect example of operating leverage. See, the blue bars show they almost tripled how much they spent on R&D, investing in the future. But the green line shows that cost was actually going down as a percentage of their revenue. So they were getting more innovative, more efficiently. And third, you put those first 2 things together, and what do you get? You turn your company into an absolute cash-generating machine. We're talking about a projected 4x increase in free cash flow in just a couple of years. The company went from needing cash to survive to suddenly having a massive surplus. It's a total change to their financial DNA. So what did all this discipline and hard work actually get them? Let's take a look at the results, because what they built here is nothing short of a financial fortress. The biggest, most dramatic result? They completely conquered that mountain of debt we saw earlier. In just 3 years, they took their total debt from almost $4 billion down to just $330 million. That insane 57x debt-to-equity ratio? Crushed. Down to a rock-solid level below 3x. This is just a flashing green light for peak financial health. And all that discipline gave them 2 huge advantages.
First, it created a $3.6 billion war chest of cash. And second, it basically made them immune to rising interest rates. Think about it. Their interest payments are less than 0.1% of their free cash flow. So they're completely insulated from whatever the Fed decides to do. And this financial health had a really nice side effect for anyone looking to invest now. The company's valuation came back down to earth. Back in 2022, you were paying an eye-watering 237 times the company's book value. By 2025, that's expected to be a much more reasonable 14.8 times. Simply put, you're paying a lot less for each dollar of the company's equity today. So the picture looks pretty perfect, right? They've got growth, they've got profits, they have a rock-solid balance sheet. So what's the catch? Because with every great investment story, there's always some fine print. Let's be clear, the verdict here is overwhelmingly positive. Palo Alto Networks has, for all intents and purposes, graduated. They checked every single box, kept growing, flipped to profitability, crushed their debt, and quadrupled their cash flow. They successfully morphed from a speculative growth stock into a true, profitable industry titan. But there is that one piece of fine print, the one catch that every investor really needs to know about. And it boils down to this simple idea. You own a slightly smaller piece of the pie every year. So here's the deal. The hidden cost of getting and keeping the best people in cybersecurity has been share dilution. This chart shows that even though the company is buying back its own stock, the total number of shares out there keeps ticking up. That's because of stock-based compensation, paying employees with shares. It's really the one risk factor left that investors need to keep a close eye on. Which brings us to the big question for you. When you look at this whole story, which company would you rather own? The risky, super fast growth version from back in 2022, or the stable, cash printing machine it is today? Let us know which one you'd pick down in the comments. And hey, more importantly, if you want to see a full financial breakdown like this for a company that you own or you're thinking about buying, tell us. Drop the ticker symbol for it in the comments below. We're going to be looking right there in your suggestions for our next deep dive. So don't forget to like this one, share it with a friend, and of course, subscribe so you don't miss what's coming up next. Thanks for watching.